Jairam Sampath, whole-time director with Kaynes, joins us now, and let's understand what his outlook for 2025 is. For 2025, there would be a big factor at play, which is tariffs. And we don't know which way the cookie would crumble. In favor of India, against India. But whatever said and done, tariff will keep everyone occupied for the first 6 months of next year. How do you envisage things changing for Kaynes, for the good and for the bad, because things are going to change?
Hey, so good morning and thank you for having me on the show. As a broad commentary, tariffs at best matter in the short term. So it's my belief, and we always work on that basis, that over long term, the real merit of the company will show up despite the tariff troubles. Having said that, companies like us today, we don't have very significant, let's say, proportion of our sales going into, let's say, US or something at this point in time. And we see the tariff barrier as an opportunity to build our US manufacturing, actually. We did a small acquisition last year, a small company, just to figure out all the cultural issues that you do when you integrate companies of that nature and meet customers, etc. We're quite encouraged, and we now have a fairly robust incoming RFQs, and we might go in that direction. So if there are tariff barriers, then we go inside US and then set up companies, right? And then do value addition there. And so with the new dispensation, I think that will also be seen favorably. So as far as we are concerned, so far the tailwinds for the growth story is driven by indigenization of imports. So that's like what we call the Kaynes 0.9. Kaynes 1.0 is when we reach $1 billion in about FY28, and along with semicon and PC board, etc. Semicon and PC board are high capital intensive, and they probably can take us to some 5,000-6,000 crores of additional sales by FY30. So in order to add quantum of sales and growth, we need some more beachheads. One, of course, is we started with the domestic, which is imported substitution. The second one is additional value addition through semiconductor assembly and so on. We need to add geographies. We need to add some design capabilities. We need to add some technological, what I call deepening. So I think the real differentiator between companies would be those who bet on technology to drive their growth. Now, because most of the tariff barriers eventually will come down. Even in India, we did start with some tariff barriers, etc. But now we are welcoming companies to come and do a JV here. So it won't make a difference, having tariff barrier or having a Chinese company working in India. So from our perspective, short term, a little bit of adjustment need to be done if you have some exports and so on. But in the long term, it probably wouldn't matter. Especially the driver of our prosperity is based on demand-supply gap, and we think still the demand-supply gap will significantly exist. And like I said, if there are tariff barriers being imposed in the US, we'll have to go in there and then work with, let's say, the US government and set up factories there.
Okay. But when you interact with, let's say, your buyers, have they indicated anything that start thinking about plan B? If tariffs they come on India exports, we need to relocate. We like you, but the fact that if there's a 10% tariff imposition, also suddenly the viability changes.
Yeah, see, 10% is not going to make the shift. We, especially in our kind of area, most of those companies abroad, they enjoy something like a 20% premium. So they would not be able to quickly come down to these kinds of levels of pricing, at least on most of the electronics. So any of these tariff barriers would lead to some kind of an inflationary spiral. So I think we would not like to test out that cycle. We would just like to work with it and use the time and energy. So we are currently dependent about 10-12% on exports of, let's say, the EMS side. And of course, another 3-4 years time frame, significant exports from semiconductor assembly and those kinds of things will happen. So from our perspective, we would work with the whatever policy pronouncement each government has. And there's still a lot of demand supply gap. We have not heard from any of the customers saying, hey, we do have significant RFQs in FY26. A lot of business is going to be done outside, but that is also driven by domestic demand. Like, for instance, the aircraft purchase of Government of India drives demand in aerospace electronics, right? So those things I don't think will change materially. So I think this tariff barrier business is more a show of strength rather than really an economic policy tool, because everybody knows that they cannot make things costly for themselves. However, they'll welcome, certainly, irrespective of whether they have barriers or not, they'll welcome manufacturing within the geography, which we also believe that we have to become a global company, and then we should have manufacturing bases in US, Europe, even South Asia. Why not? Because South Asia is also a large consumer of electronics, actually.
Good morning, Mr. Sampath. Cheryl also joining in the conversation, and want to shift focus to the semiconductor business of yours. And if you could help us understand what part of the semiconductor value chain do you actually aim to capture when you talk about the longer term? And also if you have actually devised sort of a roadmap for it, any revenue potential, the timeline for it?
Sure. So I had briefly mentioned these are capital intensive businesses. So depending on how much capex you do, we are putting about the capex is about 3,400 crores. So this can probably at best yield a revenue of about 4,000, 4,500 crores, and this probably will peak out by FY30. And excuse me. So this year we get the POC line prepared, and then in the coming year, that is FY26 first quarter, we complete the POC, that's proof of concept. By fourth quarter of FY26, we think we will have some significant commercial revenues. 27 onwards, some better capacity utilization. So of the total capex, we are aiming about 25% of the capex on what is known as legacy packaging, which is the older generation of packaging. It's our belief that over time we need to move to advanced packaging. So a significant, or rather a substantive portion of our capex actually goes into advanced packaging machinery. So this advanced packaging is likely to kind of yield better margins and also probably keep us at the leading edge of the technology. Because it's our belief that over time, the geography, it does not matter where you are working. I think everybody will have access to those factors of production. So the companies who win in these kinds of areas will be companies who are having better technology. So we are not only working on making sure that we get into advanced packaging, we're also working working around this entire semicon to do some little bit of design help to our customers, and also deepening of technology footprint. It could mean some further backward integrations also in areas where it's possible to do. And so you can roughly say that by FY30, we get to about 4,000, 4,500 crores of turnover in this area. And by FY28, maybe around 1,500 crores will be the kind of revenues that you can expect in the semicon assembly alone on a standalone basis.
Okay. So if one has to look at your FY26 projections, where you've already indicated a 35 to 40% growth, you've indicated margins in mid-teens, you will stand by it?
Yeah, there is no reason for us to believe that margins will anytime soon cool off. So margins will remain hot, and I think that's because of the kind of category of businesses that we are in. In fact, to tell you honestly, last 1.5 years' time, we've not had, let's say, a very huge, fast clip business in areas where actually we do well, like railway signaling or any of those kinds of areas. And I think now that the election schedules are all done, and at the next 3 years, we could look at some kind of spend by government too. And with a new dispensation with the RBI, etc. I'm sure this is all to aid governments to invest into new generation of technology in railways and in telecom and in administrative infrastructure and power electronics and all of that. Because those are all inexpensive capex compared to all other capexes, and they actually propel your country a little much faster into the prosperity growth. And also, I'm sure the government is talking about high capacity let's say servers, etc. I think the NVIDIA chief was also here. So all of these, I think government is erring towards, not erring, the government is like the, let's say, leaning towards higher tech, which is actually correct. Because this is the time when the rest of the world is figuring out what to do. I think we should go and achieve our solus positioning there. And there's no real reason for us to actually now sit back and say we'll do second grade technology, right? So almost in every area of work, if you see, there are companies who are excellent and who have done very well. Of course, in the financial services sector and entire, let's say, e-commerce and all of that, we have a world standard already achieved and probably bettering it. And so similarly in hardware also, we think we would do that. So FY26 will be certainly a reasonable growth. I think on a consolidated basis, we'll continue with the same growth that we have had in the past. And of course, with a little bit of help from, let's say, Semicon and even PC board, which will start yielding some revenues towards the fourth quarter. But nevertheless, even if those revenues are not very material, I think we'd still get to the number which is in keeping with the growth rates that you see this year.
All right, then we leave it there, Mr. Sampath. Thank you so much for joining us on ET Now to talk about Kaynes Technology, the future roadmap going in for your various businesses. Well, on that note, let's slip into a break on this edition of The First Rate. More on the other side. Don't go anywhere.